Good afternoon, everyone. I am Sulakshna, hosting this webinar on behalf of Wadhwani Foundation National Entrepreneurship Network. WFNEN is doing a phenomenal job in supporting startups, early stage and growth stage entrepreneurs and SMEs to grow their business. Entrepreneurs need mentors to scale their business to the next level, and WFNEN provides such mentoring and learning platform for free to those who come and register at wfnen.org. The mechanism is a very straightforward approach with goal-based, time-bound, and structured mentoring. Enrich yourself connecting to 400 plus mentors from various fields of work and make a difference. As we begin, I'm so pleased to be with you and to have the chance to introduce our speaker, Hari Krishnan. Hari Krishnan leads investments at Extract Venture as the fund manager. He has over 15 years of experience, of which over 6 years as an entrepreneur, co-founded a startup in the education space that raised angel investment before getting acquired by a listed education player. His current portfolio of investments include Foyer, PalmEasy, Whoopler, Rapido, Travelkhana, Absentia VR, Find Me a Shoe, and Hyperloop One. Prior to Extract, Hari served as the Senior Vice President at Venture Intelligence, a leading research firm on VC, PA, and M&A deal activity in India. Hari began his career as a software engineer at Patni Computer Systems, currently called as iGate, and has an integrated master's in management from BITS Pilani. After the presentation, we have a discussion session for around 20 minutes where Hari would answer your questions. So please send me relevant questions over chat, which would be answered at the end of the session. I would love to have your feedback on today's session. Your input and suggestion for future sessions are invaluable to me. So please leave your feedback on the poll and survey at the end of the session. Entrepreneurs and attendees who are here today have a great session, and check back the webinar link on the website to hear the recorded version for self-learning and access the presentation anytime. You can also connect with the speaker who is also a mentor at wfnen.org. Over to you, Hari.
Thanks, Sulakshna, for the kind introduction. Hi, everybody. Very good afternoon. I hope I'll try and make it live after a lunch hour. So here we are to discuss what to expect in an investor due diligence. And how to be prepared for a smooth diligence, right? Background of past 2 rounds of investment startup phase and ventures, having seen 10 deals that we have done, and subsequently 8 of these investments have taken multiple follow-on rounds post that. From these experiences, I'm trying to sort of share a very basic level of requirement and preparation that a DD needs from an entrepreneur point of view. Anytime you feel you need to ask questions, maybe you can put your question on the chat window and we could probably answer it towards the end. So I'm going to start with why is DD done and how it is done, and post that also probably give you a heads up on how to prepare for the DD, and cover the 3 different DD aspects: the business DD, the financial due diligence, and the legal due diligence. And within each of these, we will also divide them into regulatory compliance versus business required diligence within each of these domains, and also a few small tips and what could be the budgets involved in doing the DD, etc. Right? So why do we do due diligence, right? So as an investor, we are going to invest a large capital in an entrepreneur or a startup with whom we have very limited interactions, right? So the investment is a bet on the founder, the founding team, and the business, the sector, right? So So, and while we discuss or we receive the pitch from the entrepreneur and have initial discussions, the entrepreneur presents the idea, business idea, we do very about the, because we are sort of in a business, talking to several players in the business. So we know if there is a pain point. If it's a consumer business, we ourselves are probably consumers, and we would be able to relate to it by putting ourselves in the shoes of the consumer. Probably in areas like market size, when you claim, there again we would probably do a preliminary check from our industry sources, or talking to some large players in the industry, traditional companies in the same industry, and probably also we might dig into a few research reports which we sort of have confidence in. And in terms of the claims that are made by the company, which are, let's say, for example, you have 10 lakhs of revenue last month, right? And out of that, you have unit economics, which is tending towards positive in the contribution margin 1, and contribution margin 2 is so and so and so on and so forth, right? So when you give us numbers like that, we believe and trust those claims at the first instance and make our in principle decisions, right? When we have our internal discussions within our IC, etc., we take these numbers at face value and go ahead with an in principle decision for or against investing, right? So let us assume we are deciding for investing. So whatever claims you made, we have not verified it when we decide, and then we come back to you giving a term sheet. After the term sheet is when we start actually doing the due diligence, we start verifying these, right? So it's important to keep in mind to make only correct claims. So when you upfront discuss, right? So you might, being an entrepreneur, you might always feel, X number of downloads, X number of users, X number of, X amount of session time, engagement time, etc. You might always tend to probably, talk about it or talk it up a bit, right? But please refrain from doing so. It's good to sort of under claim and over deliver, right? If you always say, I have session active users of, let's say, 100,000 and monthly active users of, let's say, 20,000, and my average order value is, let's say, 800, and end of the diligence, if we discover it's better, right? If it's a 90-minute session time, but you rounded it off to 18, it's 110,000 users on a daily active basis, but you claimed only 100,000 users, your average order value is 857 and you claimed 800, great, right? We would love to, move faster. We won't probably, penny pinch on the last mile negotiation post the diligence if we get these kind of signals from the entrepreneur, right? So always sort of, don't overclaim, don't overstate the facts, because have to face the reality. So it's always good to be upfront on the actual claims. And the diligence exercise is done just to, 95% of the deals that we 99% will go through, right? Unless otherwise there is something which is very big as a red flag, right? And this is also, as I said, we also get to know how the founder thinks and works, right? So it's a founder behavior sampling exercise, right? We know whether you undercommit, over deliver, kind of an entrepreneur, right? So obviously also to make the company in good standing on the regulatory compliance aspects, right? There are a bunch of regulatory things which we need to be in good standing on, including taxes, PF, the statutory claims, other statutory claims, and other legal regulation if you are supposed to get registered in a particular industry body or a particular department of the government, and all your MCA, ROC filings, and so on and so forth, right? Statutory taxes like service tax, these days GST, and so on and so forth. So now we know why a DD happens. So how does it happen? So who are all involved and how does it happen, right? So there are three aspects in a DD. So one is a business DD and a financial DD and a legal DD, right? So in a business diligence, this is a key diligence. So who are all involved in a business diligence? It could be people from the industry who are in a similar line of business, but probably in a traditional line of business, not probably using technology, maybe. They could be involved, and probably some domain experts could be involved, probably some researchers in those areas could be involved. And on the financial diligence, you typically have a chartered accountant or a auditor who's involved. Some of the larger deals would have the big four being engaged for the financial DD. And obviously in a legal DD, you will have a lawyer who's involved, a corporate lawyer. And so who does engagement of these people? It's typically the investor who nominates, a person or an entity for doing each of these parts. It could be multiple people. For example, in a business diligence, there could be multiple people who could be involved. And business diligence could be a informal exercise as well. They would probably not do a structured diligence process, but they might just introduce you to a bunch of friends of the funds, friends of the investors, and probably ask you to have a conversation with them. And that probably would form the business diligence, apart from whatever diligence that the fund is doing directly on their own without having you involved in the process. And on the steps, typically there are these key handful of steps. Obviously, the first one is the business diligence, which is pre the term sheet. When the fund decides that this is a good investment, good sector to be in, good trend, good company, good founder to back, they do basic diligence. Let's say typically on the market size, is that large enough? Is it $1 billion business? Is it calculatable from a bottom-up perspective to be a large business, not just a Gartner report that says it's a multi-billion-dollar business, but I know there are n number of customers, each one will pay so much on a periodic basis, and then they will continue to pay month on month for so many years, and I will get so much of a commission out of it as a revenue, and that amounts to so many $1 billion, right? Number two, there are other companies traditionally in this business, and they are at so many, so much of revenue. So that gives a, equivalent of what a company, the size of the revenue of a company can be in this space, for example, and so on and so forth. So these are some basic business diligence that are done. And step two, investor gives a term sheet, and post the term sheet is when the detailed diligence, especially on talking to your customers at length, IP diligence, patent diligence, legal diligence, financial diligence, etc. are done, right? So again, there is sometimes some people want to do as part of the business diligence, talk to your customers, right, before giving the term sheet. This is common practice. Some funds will ask for this. Some entrepreneurs are comfortable doing this. One drawback of exposing your customers before a term sheet to a investor is sometimes that the investor may not be very serious in his decision making cycle. He's not yet made up his mind, but he might talk to the customer, and sometimes he may not be very bullish. He might have some critical views that he would want to talk to customers, and customers will also get partially influenced by it. So you might want to be a little careful about how do you handle that. So you might have to set expectation to the customer accordingly, that he need not be influenced by the investor conversation, number one. Number two is that sometimes you might obviously keep talking to multiple investors. So you don't want a customer to get calls from 5 different investors in the next 30 days time frame, right, or the next 2-3 months time frame. So the customer will not have a great opinion. I mean, these guys are talking to several investors, none of them is investing, or he may not even have the time or the bandwidth or the inclination to talk to prospective investors of your company, right? So to that extent, be a little careful in terms of opening up your customers for conversations with your investors as part of business diligence. It might be required that the investor needs to understand the space, the depth of the pain point, etc., from customer conversations. So sometimes, you might, be able to negotiate or push back a little, saying that, hey, if you're serious, give me a term sheet and then I will make some introductions, right? Or you might be selective. If you have 10 customers, introduce only 2 customers whom you know very well, probably who have been historically dealing with the company for a while, and not open up everybody, right? Or if it's a consumer business, don't give, let's say if you have 20,000 consumers, open up only, let's say 100 consumers, right? Maybe the criteria for opening up the database of 100 consumers can be set jointly by the investor and yourself. Let's say, for example, the week of July 20th, right? It's a random 1 week of data that you give, right? So that the investor also doesn't feel you're giving a very selective, biased sample to talk to, etc. Right? So, but a very limited sample, right? It's only 1 week of data, for example. So that is one critical aspect in a business diligence that comes before a term sheet or after. If it's after a term sheet, you might be probably a little more considerate, give a little more access to your consumers' data or customers' data. Again, you might also have to check the data privacy issues, how much of it can you open up, etc. So it's a little bit of a tricky thing you have to do, DD, but you will have to be a little cautious on privacy of your consumers in terms of sharing data, etc. And yeah, so after you do the 3 major DD aspects, at the end of it, each DD person would come back to you or come back to the fund with a list of issues found during the DD, and then you'll sit with the investor or sit with the DD person or entity and find ways to solve those issues, right? Most of them would be issues that could be solved, while 1 or 2 could be bigger issues which may not be solvable in a requisite time frame or using the resources that you have. So those are points for negotiation. You could always go to the investor and say, hey, I know that I have not paid service tax for the last 3 months because I did not have cash flows, but if only if the funding comes, I'll be able to pay. Then the investor might be okay with it, or the investor might say, you know what, we want to come into a company only when it is clean. So why don't you go pay up 3 lakhs or 10 lakhs of the dues? I will give you an advance of this from the amount that I propose to fund, and then you go clear the dues and then come back with a clean sheet, and then I'll infuse the rest of the funds, right? So sometimes it might so happen in your negotiation, or sometimes you might also tell the investor, I will do it post closing. So it's not a condition precedent to the investment, but it is condition subsequent. You can define what parts can be pushed to what stage, right? So that your investment or the fund infusion into the company is not held back because of some reasons which are probably only administrative in nature, right? So yeah, so in terms of preparation, so what is the goal, right? So we are here to minimize the amount of time that it takes for the funding round to be closed. As an entrepreneur, you always want to finish the funding as of yesterday and go run your business, right? You want to focus on your business, focus on growing, focus on hiring, focus on expanding with the new money that you've got. So how can you reduce the time of diligence, right? And more often than not, investors are willing to listen to proposals that you can make, narrow down the scope to really the things that they want to diligence upon, because a lot of startups don't have too many areas where the investors will have questions, right? So they would want only basic level of things to be diligenced on, and couple of specific areas that they want to sort of get a little more conviction on, right? So if you can sort of scope that out very clearly by upfront discussing with them, right? And in the process also make clear, abundant disclosures. If you have a few areas where you have question marks that I'm not probably fully compliant or fully satisfied with a few things in my company, go tell that upfront, saying that, hey, I know I have not been able to do this, probably pay service tax or PF or ABC, but that is just because I am putting my cash flows into something else, into sales probably, and not into this, but I will be able to do this once I get the funding or whatever reason I've not been able to do it. Tell it upfront and people are okay with that, right? So it's only when expectations are not met that people are, unhappy and they could sort of form a bad judgment. But if you tell them upfront and they find that to be true for some genuine reasons, people are always okay, right? Because most investors in India, as you know, have been entrepreneurs themselves, so they know what it takes and they know what are ignorables, right? A few things are ignorables in the Indian context in terms of when you do business, right? So yeah, so the scope of diligence is negotiable, and for example, one portfolio company that we invested out of the 10 investments we made, there is one particular company which came to us and said, for financial diligence, I will give only 3 hours of my time, and for legal diligence, another 3 hours. So it's only this. Send me whoever you want. Give me documents that I need to keep ready, and within this 3 hours for DD of finance, 3 hours of legal DD, we are done, right? Beyond that, I will not allow you to do diligence. He was able to negotiate that with us. We were also very eager to do the deal, so probably we agreed as well. So it also depends on, where you are on the negotiating table, who has the strength, who's more desperate on the table, etc. Right? But even otherwise, even if there is no competition for a deal, most funds are happy to sort of, give in if you give them very narrowed down scope for the diligence, right? And the diligence also, keep it in mind that it will be commensurate with the kind of ticket size that an investor is bringing in, or even the stage of investment, right? For a seed stage company, you don't want an extensive financial diligence, right? Because there's not too much of financial history in the company, firstly, right? So you should always keep that scope narrowed down in a seed stage or even in a pre-series A stage, right? Obviously, series A and series B and so on are going to be more elaborate. There's a lot of history, a lot of data to check and verify, a lot of financial information, legal information, and also a lot of money at stake, right? So what we have found work really well is when the founder has a checklist on his own, or even ask a fund, right? But I would say even before asking the fund, have a basic checklist on your own that is typically used by your lawyers or your financial due diligence partners. Get them and do a dry run internally. So give a financial DD checklist to your accountant, give a legal DD checklist to either your in-house lawyer or even to your admin guy or your HR guy, or you yourself can run through each of those checklist items and keep those documents ready. And if there are a few things that you're not ready with, get them ready before the actual DD begins with an investor, right? So this will help you cut short the time, to a very significant extent. Believe me, DD typically takes about 2 months in investment context in India. But the real, time killing aspect is getting the documents ready in place, right? The actual DD is only a small duration event. It's probably not more than a week time. But getting the documents in place is the biggest time killer. If you can get all the documents ready, put them on a Dropbox or a Google Drive, share it with your investor and say, here is all my documents, share it with your DD partner and let him go through it and then come and do a inspection or a proper DD after that, right? So this saves a lot of time. Business diligence. Yeah, so this is a key investment make or break decision, right? And most often it is done in a B2B or a tech, deep tech sort of investment space. So why does an investor do a BizDD? Obviously, he wants to be sure that the industry needs and vouchers for the startup. So as I said, he would get an industry expert or a domain expert introduced to you and want you to have a conversation with him, and he will go and ask the industry expert, to sign off on this deal, right? Acknowledge that this is a great problem at this point in time to solve for the startup, for the industry, right? So what happens? The investor introduces to a domain expert, and then one good news is that whatever be the outcome of the due diligence, typically there is a plus to the industry person's interaction, right? So they typically end up becoming, partners or advisors, or they sometimes even co-invest into the round, right? So we had, I can share with you two, instances. So one portfolio company that we invested in, when we did a Series A, fundraise after our seed investment. So the new incoming investor, prospective investor, introduced him to a large, media entertainment company. And the CEO of that large media entertainment company, it's a listed entity. So he spent good time with this founder on the problem statement and the solution that these guys are proposing. He was so excited that he went and told the new investor that he wants to invest into the company, right? So he ended up becoming a co-investor in the company. And because an industry player, a large listed traditional industry player invested into the company, it's becoming very easy for the startup to go and distribute their product into the market. So they have become a channel partner, right? And because they have, good number of, distributors into the, market, the startup is able to sell their, product very easily into the market. So this is it's a good, step in the diligence that might help you. There is another, instance where one of our investee companies got introduced by the new prospective investor to ex-CEO of a traditional company in that domain. And the new prospective investor did not invest, for whatever reason they probably didn't chose to pass the deal. But the guy who did the diligence, after the diligence exercise, I mean, the guy who did the business diligence, so he ended up signing as an advisor for this company. So that's a good ending as well. So, irrespective of the outcome, business diligence is a great thing. And good investors always introduce you to multiple people as part of business diligence, as part of help that they would do to a startup, even if they're not investing. But proactively, cheerfully take this up. Be open to talk to as many people, as many industry guys that the prospective investor is introducing you to. Be open in conversations. There could be some secret sauce elements that you would want to keep it a little guarded, but otherwise be open in your discussions. And normally I've found it, as a win-win for everybody, right? And so the second part of business diligence is that investor would speak to your customers, your partners as well, right? As I said, to understand the pain point deeply and so on and so forth, right? So you might, as discussed, want to be a little, cautious on, how many customers you sort of open up with the investor, and when do you open this up? So typically after the term sheet is ideal, but sometimes, if the investor requests, maybe you can open up a few customers before the term sheet stage as well. And the financial diligence. So why does a investor does financial diligence? So it's mainly just to verify revenues. Are you overstating revenues? So that's the 90% of the reason why someone would want to do a financial diligence, right? So keep all the invoices, proper. Make all your income come to your bank account, right? Do not have any cash transactions in your revenues. So I think, and report right revenues, right historic revenues that you claim, because those will be verified, and any deviation from there will be a big red flag, right? So be very cautious on what you claim before the diligence during your pitching in time, right? And obviously the other reason is that, there are not expenses that are being, siphoned off, or promoter expenses out, some of his large personal expenses as part of the company, etc. Obviously these are, red flags, but these are not done in 99% of the companies, but this is what is being checked, right? And what are some of the checklist items? Typically the financial statements, which is basically the balance sheet, profit and loss, and the cash flow statement, and preferably audited financials if you have more than 1 year of history, and up to the financial year end, March 31st ending, or unaudited financial statements till the last quarter, right? So, and typically both, right? So income statement, which is profit and loss statement, balance sheet, and cash flow statement. That's the first one. Second, the entire accounts. So which is basically people will want access to your accounting software, be it Tally, QuickBooks, whatever. Keep it up to date, and you might want to give a copy to them during the diligence process, and all supporting documents. So if you have made entries into your accounting software, be it revenues or expenses, you should have supporting documents for every entry made, right? Unless it's a very small petty expense. Any revenues, it has to be backed by invoices. It has to be backed by VAT or service tax or GST. Now, those filings made, and any expense has to be again with a vendor invoice, and all of these have to be bank transactions, not cash transactions, right? And yeah, any loan agreement. If the company has taken any loan, need to have a proper agreement, and the loan should have come into the company typically through a bank statement, and not typically taken by the founder, and then the founder infuses money, and then you have the loan shown as coming from a third party, right? So those are not preferred mechanisms. Again, to take loans, there are other checks and balances as per the company's law. You will have to ask your auditor as to what is the right method of infusing loan into the company. Is it via directors? Is it via shareholders? Can a founder infuse money into the company, etc., etc., right? And also the cap table. So cap table is basically the list of shareholders of your company as on date, and people who have come through multiple ways into the company. It could be founders, it could be advisors who got in sweat equity, it could be ESOP, it could be share transfers that you have sold some shares or bought some shares within the promoters among yourselves, and maybe that there could have been a small friends and family round, or a angel round, or a previous investor fund infusion. So all of this has to be captured on a timeline basis. So meaning you should have, for every activity there has to be a cap table. So if there was one fund infusion, have one cap table. There was an ESOP, have a cap table post that. There was share purchase, share transfer done among the existing shareholders, have one cap table. So it has to be a cap table at every point in time in the previous incidences of any change in cap table, and proof of each of them. So have ESOP certificates or the share certificates, everything documented, clean, have it ready. Legal diligence, again, there are two types of legal diligence. So one is a business legal diligence, and one is a company legal diligence. So I'll come to the first part, which is the business legal diligence, right? So when an investor is signing up to invest in your company, sometimes it might so happen that some of the sectors may not be fully regulatory cleared sectors, right? So in India, a lot of sectors are governed by several rules, and sometimes by the state government, sometimes by the central government. There are multiple agencies involved. There could be an industry body that could sort of monitor the regulatory aspect in that industry, and so on and so forth. So you will have to be compliant with all these aspects, and sometimes if you're not compliant, sometimes it might be a gray area. Sometimes it might even be downright not legal at all, right? For example, a peer-to-peer lending till a few months back, why even few months, till even last month, it was completely illegal, right, in India. Until RBI came with a resolution, maybe a draft resolution now, or a resolution itself, and it's now becoming more and more accepted regulatorily, right? So even our case, so we have invested in a couple of investments which are in the non-regulated or not fully compliant areas. But does it mean all investors will be ready to invest in such areas? Not really. Some investors are okay to take the regulatory risk. Some investors are not, right? So how do you sort of judge what sort of risk is okay, right? So my basic thumb rule is, if it's a win-win for every stakeholder, right? So by every stakeholder, I mean the government, the public at large, the people who are current suppliers to that ecosystem, the consumers to the ecosystem, and obviously the founder and the investor, right? So if it's good for everybody, typically the regulation will follow. For example, we invested in an online pharma delivery company, pharmacy e-commerce, right? So pharmacy e-commerce is still not 100% fully free, clean sheet regulatory. But by the time we invested 2 years back to now, the regulation has changed drastically. It's a 180-degree turn, right? At some point in time, people said it's illegal to deliver medicines to home, right? But now it's come a long way. There is a pharma regulatory committee that has come up, that has given regulations, draft regulations which have come out. Multiple iterations have been done on that. Now it's almost legal. There is a move towards becoming legal. Similarly, another company where we invested is in the bike taxi space, right? So there was no law in India. Even today in many states there is no law. Again, the regulation moved because these are industries where everybody benefits. The congestion is going away, traffic snarls, time to transport, it's more greener if you travel on a two-wheeler than a four-wheeler, and so on and so forth, right? So as long as there are larger benefits, typically regulation comes favorable over a period of time. You'll also have to be lucky. If you get the timing wrong, if the regulation comes favorable after 5 years, if you don't survive for 5 years, it's a problem. So that is a risk, but you will have to weigh the risk and take the regulatory sort of risks as you go. And some of the VCs are downright not okay with taking any sort of regulatory risk. Even if the regulatory scene is improving, they might just say, because most of them have when they have raised money from their global institutional investors, or when they have their global IC meetings, they have a very clear mandate saying that we will only invest in legally very clear areas. So some VCs may not be able to invest in some of the gray area businesses. And but coming to the second type of the legal aspect, which is the compliance risk or the corporate legal aspect, there you will have to be fully compliant, which is basically all the mandatory registrations like service tax, companies, shops and establishment act, and ROC filings, MCA filings, income tax filings, PF, etc., if they are applicable in your case, and so on and so forth. So this is a necessary compliance aspect, and all VCs will want compliance in this regard. Right? So what are some of the checklist items? So in the deep tech companies, you have patent or IP, which will get checked. Patent applications, have them thoroughly filed. And a lot of companies have questions here, right? So because I'm a small startup, I don't have money to file patents. Patents are costly. Agree. But in my opinion, when someone comes and pitches me a deep tech idea and says that he has filed a global patent, not an India patent. India patent is not very valuable as a perception among investors. If you have filed a global patent, may not be granted, that's fine, understandable, but you should have done at least the application, right? So that, in my opinion, is a good indication that there is some real IP. If you have a good patent attorney who have gone through your IP and has done a prior art search properly, he will search against the global patents that have been applied so far, granted so far, and if there is no clash, he accepts your application and files an application and it is not rejected so far, it's a very good sign. It also has a meaningful impact on A, the investment decision itself, and B, the valuation of the investment, right? So any money that you spend on a patent application, a global patent application, while it is costly, typically we have worked with some of our portfolio companies, have worked with global patent attorneys who typically charge 7-8 lakhs per patent application, but it's worth it. Be open to this, have a budget for this. It's okay to spend on this. It has a good return in terms of higher perception and higher valuation while the investment goes through. And the other basic things that are required would be your founder agreements. This is another thing that we don't see in the Indian context. Founders do not have a founders agreement in place. please try and have a founder's agreement, a founder shareholder understanding between the founders, between the co-founders, right? Who holds how much, who came in when, and who will take care of what aspects of the business. Broadly, it changes, that's fine. But just as a matter of understanding that you have verbally, put it on paper. And what happens when a founder exits? That's a very key question. Not many of us answer it. During my startup days, did not answer this question. There was founder exits, but we did not have it covered properly. But it's tough to take those decisions because founders are friends typically, right? They've been working with you, they've been studying with you, probably you know them well. So, but keep this very clear. When a founder exits, how does the shareholding get treated? Do you buy it at face value? Do you buy it at half of the fair value? Vest some of it? What is the duration of vesting? Be very clear on those, right? Have those documented. So founder agreements, shareholder agreements, keep the share certificates issued. Again, a lot of companies do not issue share certificates to the initial shareholders. It becomes a verbal promise. It's on an email, etc. Please try and give share certificates as soon as possible. It builds credibility and trust with the company and also keeps you in good standing on the DD front. If you have any loans, keep loan agreements clear, mentioning clearly the duration of the loan, whether it has an element of ability to convert it into equity, what is the interest rate, and so on and so forth. Trademark applications, any litigation history. Normally, any litigation will be seen as a red flag, but if at all you have any litigation, please disclose it upfront. It's one thing to know there is a litigation and decide whether it's an ignorable or not an ignorable by the investor. It's another thing not to know of a litigation and get it discovered later, right? And you'll never be able to fundraise in the market because investors know, all investors know each other. It's a very close community and people talk to each other on different companies that they're evaluating. So always disclose upfront, it's okay. Customer contracts, employee contracts, vendor contracts, reseller agreements, all of this, have them in place, keep them ready, put them on a Dropbox, keep it ready, right? So these are the ones that will be checked during your legal diligence as well. Yeah, so coming to the budgets, before that, maybe I would probably, also go a little bit on, what happens when you find not compliant on some aspects, right? So it's always true, practical that you can never be 100% compliant. There could be, a lot of misgivings on the financial compliance front, on the tax front, on filings to authorities like ROC, etc., on maintaining your books of accounts, on maintaining your share registers, board minutes of meeting, so on and so forth, right? I mean, most of you, we understand, are first-time entrepreneurs. Most of you would not have bandwidth in terms of time or even money to engage auditors or accountants to keep all aspects of compliance in both financial and legal things in place all the time. We are fine with that. We understand it, right? So, but when issues come up, discuss, treat the priority items with higher priority, treat the lower priority items with go to your investor, negotiate timelines for it post investment, right? So most of these things can be taken care. You tell them, boss, you infuse the money within 30 days, we will get all of these things sorted, right? And if possible, proactively keep these things ready, right? You may not do it all the time, but at least when you're fundraising, before 1, 2, 3 months of fundraise, have these things in order. Try and spend some time because this eventually determines, if your fundraising can close within 3 weeks or will it take 3 months. And believe me, in 90% of the fundraisers, it takes longer time than what is really estimated. And typically companies, always come close to the, running out of cash situation by the time the fund infusion is in, right? So any time that is saved on DD saves you a lot of stress, saves you time. You don't have to lose momentum. You don't have to look for, short-term loans to bridge small, gaps in your runway, etc., etc. So any issue, treat it proactively, and any issue that comes, be upfront. You go and disclose it to the investor before he knows the bad news from the diligence company. You talk to the investor even before the diligence begins or as the diligence begins. When you realize something is missing, go tell the investor or shoot an email to him. Hey, we came to know that, we came to realize that, or we somehow missed this point. Just wanted to bring this up to you, right away from my side. So people are happy if you bring it up. It's okay, and people know nobody can be 100% compliant. It's okay as long as your key intention and key things are okay in place. People are okay to live with smaller issues, and set expectations, discuss upfront, negotiate the timelines and the scope upfront, be clear on those. I think those are the summary lessons in terms of diligence. And yeah, so what does it take? How much would these lawyers cost? How much would the financial consultants cost who do the DD, etc.? Typically, as a thumb rule, in 90% of the cases, what happens is the budgets are paid out of the investment proceeds, but they are billed to the company. So what I mean is, if a company raises 3 crores investment, and if a budget for DD for the lawyer is 3 lakhs, and for the financial diligence is 2 lakhs, so this amount, the 5 lakh amount, comes from this 3 crore that is invested by the investor. So, but it comes after the investment is made, in the sense, so 3 crore comes into the company, and the company pays from the 3 crore after issuing stake to the investor for the entire 3 crore. They give away, this 5 lakhs expense for the DD from their side. Though the DD is done by the investor, it is more often paid by the company. But is it always the case? No. Always the company can push back and say, it's a negotiation thing, right? So you always come to an investor and say, hey, diligence is something that you're doing it from your side. I don't have anything to do with the diligence. You're doing it for your safety. So you pay for it. All fair, right? Some investors are reasonable, agree partially to it. Sometimes people say, it's the industry standard, we may not be able to agree. Sometimes people say, you do 50%, I do 50%. Or the companies, the most practical thing that I found more common is companies in their term sheet put a cap to the expense. They say subject to a cap of 1 lakh or 2 lakh for the diligence expenses, right? Which is fair. So sometimes if I engage a KPMG and they give me a bill of 10 lakhs, I don't load all the 10 lakhs as an investor into the company, right? I would load only 2 lakhs into the company, and the rest 8 lakhs I've engaged as an investor from my side, so I will pay for it. So that's about the budgets. Maybe I could sort of pause it here and invite questions. If you have any questions, I'm happy to take questions. And one more point that I wanted to sort of mention in the legal DD, which I probably missed, is when you also define your business in your memorandum of understanding and articles of association, be very clear, precise, and define your business very well there. One, in your diligence it comes up, sometimes people put everything under the sun. We will do, technology-based solutions for, the global market. I mean, that is not a business definition, right? So you'll have to put what exactly are you doing, in which sector, to whom, as much as possible, but keep it broad, but keep it reasonably, descriptive of the actual business that you're doing, right? The second reason is, apart from, diligence bringing this up, the second reason is, you also, in your SSA, SHA, you put up, things that, define as, competing activity. For example, you will tell your investor that he cannot invest in a business which is competing in nature to your business, right? So for that reason, you will have to define the nature of your business very clearly. Only then your competition clauses will hold good. So that is another area to take care of, whether your definition of your business, in your articles of association or memorandum of understanding, does it rightly represent your business, right? So that's another key area that you will have to keep in mind. And as a thumb rule, so it's a legal DD and financial DD is typically 1%. It's a very ballpark thumb rule that I'm giving of the fund raised, right? Both put together typically. And at a seed or series A, you can do both of it combined at 1 lakh. That's the benchmark. At series A, you might do it at 3 lakhs each, right? So roughly 5 lakhs 4-5 lakhs is a reasonable number in my opinion, right? So I hope these basic pointers help. And if you need a checklist, write to me, and I'm available at hari@astarkventures.com, and even NEN would have a lot of resources that you can sort of take help and help you get prepared for the due diligence. Happy to take any questions.
Thank you so much. You have wonderfully explained lots and lots of details which would have otherwise, without a hawk eye, we would not have just considered how to do it. And I'm very sure that our attendees and participants are really going to benefit out of it. I'm already seeing a string of questions coming from participants, so I'll just try to connect them over to you. Participants, request you to send me questions through chat or raise your hand so that I can connect. Yeah, you can send me to chat through chat. What happens if I'm unable to connect you via the audio? So I can at least read out the questions. So I'm just taking one question after another. So please be patient and continue to send me the questions. Also, I'm opening up a poll. This poll is in regard to the webinar, what has been scheduled today in terms of the content, in terms of whatever the benefits that whatever you liked out of the webinar, please put it across to the on the poll. So I am definitely that it has been a wonderful session, and just let us start on with the question and answer now. So I have question from Chetan. So I'm opening the line for Chetan. Chetan, you can speak out now, please.
Yeah, Hari, hi. This is Chetan here. I just wanted to know if one of the founders is a defaulter in, let's say, ROC, or if he's a bank defaulter, will that hamper the due diligence and eventually the funding?
Okay, so it again depends on the severity of the default and the intent of the default, right? See, let's say, for example, to give my own example, right? So when I was running my own startup, obviously, as a startup founder, I didn't have money, and I took a car loan, a personal loan, credit card, everything, right? I was a defaulter, right? But all of it was only to sustain my startup founder life, right? I mean, I didn't have money, and I was sort of maxing out on all my credit. So that is okay. That is understandable. If I have a bad CIBIL score, nobody is going to worry about it. If I have not paid up my loans, nobody is going to worry about it. But let's say, for example, if you are in the lending business, for example, right, and the founder has in the past taken some large loans for a business purpose and has willfully defaulted, right? So that is taken as a red flag, right? So people would not want, especially given the nature of business, the startup which is going to be in lending business, you want to keep your NPAs low. You want to have a very clean sort of credit history for your customers, and that starts with discipline at the founder level, right? So that would probably be a red flag in that occasion, especially if it's a willful default. Yeah. So that's. I hope that answers.
Yes. Thanks a lot.
So next question I'm opening for Jyotishman. Jyotishman, you can please ask your question.
Hello, Hari. This is Jyotishman. Yeah. The query is regarding the founder director. Can he infuse loan money in the company, and how much in relation to the paid up and authorized capital? This would be unsecured loans. And does it require any agreement between the director and the company?
Okay, so see again, I'm aware of this being sort of changed a couple of times in the recent past. So I would leave it, leave you or recommend you to sort of consult a lawyer on this. Broadly, if you ask me, only a director can lend to a company, right? That was the rule some time back, but then later it changed to state that anybody can lend to a company. But again, it with a clause saying that only a corporate can lend, not an individual. And then finally, the last thing I remember is that anybody can lend, right? But you will have to check, because the Companies Law Act changed in 2013, which came into effect recently, and they made some exceptions to it. So I would urge you to consult a lawyer for that. In my opinion, it's okay to lend, and especially if it's small amounts, the penalties are not very big, especially given that the startup will not have any other source to find monies, etc. Normally it should be okay. But as an alternative, if that is legally not possible, the founder can always infuse money into the company as an equity. And if he wants to take it back after the fundraise, etc., he can sell out a little bit to cover that money back, right? So that's a workaround. And the second question, should there be a document or an agreement between the company and the founder? Definitely yes. If it's a loan, it has to be documented very clearly. There has to be a reasonable interest rate on that as well, right? And these are the legal aspects. Stepping back a little and looking from an investor point of view, right? Typically, as an investor, when I look a company where the founder has given money to the company as a loan and wants to take it back, I'm not very happy, right? I would say, boss, if the founder is putting money to the company, let him put it as equity, right? If it's your family money, that's understandable. If it's not, let's say even your parental money, but let's say you're getting it from your uncle or sister or some one level out, and that's a loan, that's okay, completely okay to get it into the company and get it repaid after an investor comes in. But if it's founder's own money, especially for founders who have worked in the industry for about 10 odd years, the company and just wants to mitigate risk by calling it a loan and not putting it as equity money, I would not be fully happy about it. But is that a deal breaker? May not be at all. But these are small signs.
Okay, thank you.
Yep.
The next question is from S. Hari. Hari,
Hi, Hari, go ahead.
Hari, I'm opening your line, but you are self-muted. Can you please check once? Yeah, you can please ask your question. Hello, Hari.
Hi.
Yeah, please ask your question.
Hi. Okay. Because of some members or articles of association in the company, they are not seeing how to invest this money.
I didn't get that. Can you repeat the question?
Okay. Some members of they are not proceeding to the investors articles of association in the company. That is the profit and loss statement.
Okay.
Okay. The investors are, what is the main importance of the company? Why will they invest you, and how will?
Hello.
Go ahead.
Hari.
Hello. So he got dropped, I think. Maybe you can go to the next question.
Yeah. Hari, you can connect. Hello, Hari. Okay, so I'm taking up the next question from Vidhi Gupta, and in the meantime, if Hari comes back, I can once again connect to him. So I'm opening the line for Vidhi Gupta.
Sure.
Yeah, please ask
Okay.
your question. Hello.
Hello.
Hello, Vidhi. Hello, Vidhi is also self-muted. The question that Vidhi came from Vidhi was, when does the due diligence typically start? We have been asked for a customer list right after the first conversation over a phone call with an investor. Would that be the ideal time to provide a list of customers?
Yeah, so as I was also mentioning during the presentation, so see, some investors ask for such kind of information to even decide whether they want to pursue this deal further, right? Because they have 100 deals coming to them, and they would obviously focus their energies only in deals which are getting good traction, customer traction. So I think you should disclose some amount of information on your customers. I would say probably representative information. Like, for example, you could say, the largest telecom company in India has signed up as a customer, or the third largest telecom company in India is a customer. without naming them, for example, right? Or let's say, for example, if you have 40 customers or 20 customers, you give only 3 or 4 or 7 names, right? I mean, depending on what you want to inform, etc. And then the rest of it, you sort of say that, we'll be happy to disclose it as we progress, right? Yeah, so I think, yeah, some names, especially they've not even met you, it's only one conversation, probably I would, prefer giving, sort of a, without identity, giving some basic descriptive information. But see, end of the day, you will have to keep the investor interested in your company, right? You don't want to lose out his interest. So without hampering that process, but at the same time, without, see, end of the day, what do you lose by giving too much information, right? Not so much, as long as you're not giving contact information of the customer. If you're giving names, maybe it should be okay. Or if you're giving indicative list of customers, I think that should be okay. See, and also it depends on the nature of the investor. If it's a reputed investor, you can always sort of, trust to begin with that they will not misuse any information, right? If you don't know who the investor is, if it's a nondescript investor or one-off investor, then you might probably be a little more cautious.
There is the next question coming from S. Ranjan. Yeah, okay. Ranjan, you can please ask your question. Ranjan, you may please ask your question. Okay, he has self-muted himself. So the question Ranjan asked was, how are the checklists that we need to look at? Who helps to build a business report and financial reports for startup founders?
Okay, so typically, I mean, most often it is the founder themselves who will have to, get all this ready. You can, if you're able to hire someone at least part-time, you should hire an accountant or an auditor, a CA, typically who makes your filings, etc. He would be able to help you with your financial checklist and financial reports and statements, etc. Keep it in order, and also partially engage a lawyer. Again, you need not spend too much of money onto this, but I would say even if you have someone engaged for even, let's say, 10,000 rupees, I think you should be able to get a lawyer spend at least 2-3 hours of their time and get the basics of your company in order, right? So I think, yeah, so the founder himself, and with a little bit of help, at least part-time, from both the accountant or an auditor and lawyer. Sometimes some CAs will be able to do most of the basic regulatory legal work as well. For example, keeping your MOA in place, share certificates in place, etc. Even an auditor would be able to do. You need not even engage a lawyer. For basic stuff, you can get your auditor. So one auditor part-time, I think he's also commonly available, not very costly. You can engage him.
There is a question from Swapnil Agarkar. Swapnil, can you please ask your question?
Hello, Hari.
Hello. Hi, Swapnil.
Can you hear me?
Yeah, go ahead.
Oh,
yes, I can.
Yeah, actually, yeah, you made this DD very clear to me. Yeah, I was actually, yeah, this term was very like a monster to me. But yeah, it was very clear to me. Yeah, right. My question is, what is the father and son duo company? We are a startup in EdTech. And as my father is also in education, so we started this company. So you said there should be an agreement between the co-founders. I mean, in this case, since we are blood related, I mean, is it that important?
Yeah, between father and son, I don't think it's required. We know the Indian context pretty well. So obviously I don't think it's required between a father and son kind of relationship.
Okay.
Yeah, but it's sort of friends as co-founders. Maybe I would expect. See, again, this is a nice to have. It's not a must-have, because we understand, it's between the founders. We don't get into what is the relationship between the founders, but it's good only for the founder. If a co-founder has to leave at some point in time, it's good for the founder to know what will happen to the shares, right? But in a
Okay.
father-son relationship, it does not matter. You're right. Yeah.
Okay. Excellent. Thank you very much, Hariji. Thank you.
Yeah. Thank you.
I'm opening the line for Ishan Pandey. Ishan, may you please ask your question? Ishan Pandey. Okay, the question from Ishan was, should a startup also go for an investor due diligence on corporate governance and conflict of interest, or would it be impolite to do so?
A very good question. So definitely it's something that's to be done. There are, you don't know who the investor is, etc. And even if they are, reputed investors, they might be conflict of interest situations. It's a little bit tricky because it's not customary or it's not a standard practice given the, how the demand supply between startups and investors are in today or any day's context, right? It's difficult, but always do a reference check, right, on an investor, primarily from a portfolio founder of that investor. So let's say if you come to me as Stark Investors, you should probably talk to any of our portfolio founders. So we've invested in 10 companies, right? So out of the 10, you would be able to relate to someone through some connection. You should talk to them and find out how we are in general. How do we relate to the founders? Are we short-sighted or are we sort of, founder-friendly? What are the terms that we do? Post-investments, how do we behave? Do we value add? Those are the things that you should definitely talk to, portfolio founders and get to know. This specific aspect of, conflict of interest is not easy to find out. But there are at least the portfolio. Let's say, for example, if you come to us with a business idea, and if you want to know whether we have already invested in such a company earlier, typically you will be able to find it from our portfolio page of our website. If it's disclosed investment, most of the investments are disclosed by most funds. Sometimes if it's undisclosed investments, if you ask the investor upfront saying, we want to know if you have any investment in this space, he might tell you, and then if it's competing, he might even tell you. But sometimes we have seen, our peers in the industry not disclose their competitive or conflict of interest situations, primarily to understand, take information from startups as well. But so yeah, I mean, that's a little bit of a, tricky situation, but I mean, end of the day, you will have to trust that 99% of investors are good. They will not sort of, be in a conflict of interest situation and not disclose it, which I've also seen. Largely, that is the case. So yeah, it's good to be a little cautious, do a little bit of ref check, and maybe you could use databases that have investors' portfolios, and Crunchbase would give you their investments. Maybe databases like Venture Intelligence will give you some of the past investments of investors, and go to their LinkedIn and see if they are connected to your competitor companies, founders, etc. Right? So typically, if I've invested even in a personal capacity to a competitor of yours, I would be connected on my LinkedIn to the founder of that company. So yeah, so those are some signs. If you find some connection, then you ask upfront this question. I see that you are related to this founder on LinkedIn. So do you have an investment relationship, or is it just a customary relationship? So yeah, I hope this answers.
I'm trying to open the line for S. Hari again. Hari, you have self-muted, so maybe you can unmute yourself and ask your question. S. Hari. So Hari had asked a question, what is the founder agreement?
Okay, so founder agreement. So typically, in most startups, we have more than one founder. So whenever there are more than one founders, you have between the founders, you have an agreement. So that's the founder agreement. So for the co-founders, right? So if there are 3 co-founders in a startup, let's say each starts with, let's say, first founder has 20% equity, second guy has 30, third guy has 40, let's say, right? So between them, they need to have an agreement to say these are the terms of association, and it's a very simple one-pager also. What happens, let's say, in the unfortunate situation when someone has to exit, right? So will that exit, let's say founder 3 exits, will he sell his shares to the rest of the founders? If he sells, will he sell it at 10 rupees or will he sell at the market price? Will he sell everything or will he sell half of it or quarter of it, right? So those are the agreements that probably that can be, those are the things that can be covered in the founder agreement. And it's always a very good practice to have a founder agreement, because a lot of times we've seen the failure of a company happens because of co-founder issues or inability to fundraise, or obviously the product market doesn't fit, right? So there is a high chance that founder related conflicts might arise, and it's always possible to prevent that by having an upfront conversation and having it captured in a founders agreement.
Okay. Hello.
Yes.
Okay. What is the main importance of the red flags?
So a red flag is something that you, let's say if you have not done something correctly, right? If you have, let's say for example, if you have not filed, let's say taxes at all, you have not filed the provident fund for all your employees for your last 1 year, for example, or if you have not paid service tax for the last 6 months, right? So it's a red flag. It's a red flag in the sense the investor will say, why have you not done it? So you're not regular. So it's an illegal, compliance issue, and I may not sort of, come into the company. I will know there is some stress or strain, or customer is not paying you enough, or you're not paying it on behalf of employees after deducting it from salaries, or things like that, right? So yeah, so I would not say small taxes unpaid or small irregularities as a red flag, but if they are major, if they are large, either in number or if it's a very critical thing, or if it indicates integrity issue of a founder, those are red flags. Or if it's an accounting loophole, those are red flags.
Okay. Yeah, thank you so much for your valuable answers.
Sure, thanks.
Hari, Chetan asks, do we need to sign an NDA before disclosing the customers to the investor?
Again, as I said, it's part of the customer diligence sort of investor diligence sort of a thing. See, it again depends. If it's a very critical information, you might ask the investor to sign NDAs. But again, as a general industry practice, investors typically do not sign NDAs because they're in the business of investing and they talk to multiple companies in the same space before deciding which one to go ahead. And whatever you put, if I sign an NDA with company A and end up not investing in that company and invest in a company B, how much ever I, not disclose the information that you have given me as a company A, it's always there, right? I mean, it's in the back of my mind, and I might use that indirectly to decide something else on behalf of company B. So, which might be against the NDA that I've signed. It could be construed as against the NDA that I've signed. It's not very easy to establish that. So typically investors resist signing NDAs unless otherwise it is a proprietary or very significant information. So I'm not too sure for customer information, but for something that's more key, let's say for example, if you're disclosing algorithm that is used in your software, if it's a AI software, let's say if you're doing some data collection through proprietary methods, if you're disclosing those kind of things, yeah, those kind of things, or patent related information, details, architecture, etc., those kind of things, NDA definitely yes. Customers, I'm not ruling out. If it's a critical information, if you think it's critical, and if you're disclosing, let's say even personally identifiable information, let's say mobile phone, email IDs, contract values, and all of your customers, then yes, it might be required in some cases. Some investors would be okay, and no harm asking the investors, right? So you can always ask the investors for an NDA. Some of them will politely decline citing the reason. Some of them will be okay to sign it.
So Chetan also asks, is there a standard checklist for documents needed for DD?
Yes, there is. As I said, it's a good practice to get a checklist and keep prepared, before the actual DD begins. You might be able to find some of them online, or you can write to me at hari@astarkventures.com. I can send you the standard checklist. Any lawyer also will be able to help you. Maybe even NEN would be able to help you.
I'm opening the line for Praveen Shinde. You have self-muted. Praveen Shinde had a question. So he had asked, my startup has started last year. Yeah, Praveen, may you please ask the question?
Hello.
Yeah, Praveen.
Yeah, my startup has started last year, and we are investing much, and right now we are not generating any revenue. So how I invite investors?
Yeah, so I mean, again, it's not all startups generate revenue in the initial stages, so it's perfectly okay, depending on the space and depending on the business model that you're following. So you can talk to investors even if you're not generating revenues. That's absolutely fine.
Okay. Okay, thank you, sir.
And investors typically don't invest to get share of your revenues, right? They're looking for valuation upside when they sell your company. So sometimes it may so happen that you may not generate revenues at all and still be able to generate value. So it's not a complete no, but yeah, any revenue is always a good indicator that your product is valued by your customer. So that way it helps, but you can still start talking to investors.
Okay. Okay, thank you, sir. Thank you.
Vidhi Gupta asks, does it matter if a founder is involved in businesses other than the startup he or she is working with?
Yeah, so this is a common thumb rule evaluation that we do. We typically do not like founders who have multiple startups or who's not full time in a particular startup. We don't consider them serious enough, right? If someone believes in an idea really so strongly with so much of conviction, only then we would tend to part with our money. If the founder themselves are not fully involved or fully signed up for that one particular idea, then it sort of is a signal that to us, I mean, the founder doesn't seem like 100% convinced on that idea, and hence we will not probably be convinced. So we typically, it's a filter. It's a first filter. We might rule out such startups even in the first meeting or first call.
There's one question from Aditya Sengupta. Aditya asks, do all bills need to be preserved in original or are scanned copies acceptable?
Yeah. So scanned copies are acceptable as a good practice. You can probably preserve the ones that are large amounts. So anything probably, let's say, more than 50,000 rupees, you preserve it. Otherwise, you do not need to. And it's have scanned copies. That is fine. I mean, I think the Companies Act allows electronic copies of bills. They consider that as legit sort of copies. And they would come and ask, as per the IT rules, they can come and ask you for any bill for the last 7 years. So 7 years of bills is what they require you to preserve as per the law.
No more questions I have received from the participants. So I assume that we can wind up the webinar now. So concluding this webinar on preparing for investor due diligence, it was a pleasure having the webinar session with Hari Krishnan. I truly appreciate the way you covered each and every topic in detail and also cleared our doubts on the same. And I would also like to express my appreciation to the participants on behalf of WFNEN for your dedicated participation on the webinar. I'm sure you had a great session, and you can check back on the webinar link on the website to hear the recorded version for self-learning and access the presentation anytime. So maybe tomorrow you can possibly connect and figure it out. You can also connect with the speaker who is also a mentor on wfnen.org, and we would also be having another webinar session shortly and would like to bring to you another enriching experience. Wish you success in your endeavor. Thank you all.
Thanks, Sulekshana. Thanks, NEN, and thanks all participants. All the best for your startups. Bye-bye.